Over the last couple of months, my portfolio is down over £5,000, so it might be time to start panicking. Only joking, this is the exact moment where most people go wrong and make a mistake that can cost them thousands. It's times like these you need to keep a cool head, because this is where real investors are made. Not by avoiding losses, but by how you react to them. So I'm going to break down exactly why my portfolio is down over £5,000, the biggest mistake I'm avoiding right now, and what I'm going to continue doing regardless of what the market does. If you're new here, me and my brother are both qualified accountants, and we provide weekly content on personal finance, which could be useful if you're looking to take control of your financial situation or just improve it. So be sure to hit that like and subscribe button so you don't miss out. So why is my portfolio down over £5,000? We've all seen the headlines: tensions in the Middle East, uncertainty around oil supply, and increase in geopolitical risks. And when that uncertainty increases, investors get nervous and the market reacts negatively. Risk tolerance decreases and money starts moving into safer assets. And when this happens on a large scale, prices across the board drop and portfolios like yours and mine take a hit. And that is exactly what we've seen over the last couple of months. And this is why my portfolio is down over the last couple of months. But here's the important part that we can't forget. This kind of reaction is completely normal by the market. Markets don't move in a straight line, especially over the short term. And during times like this, the biggest mistake I'm going to be avoiding right now, and the one that can quietly cost you thousands, is panic selling. Now, in theory, if you could perfectly time the market, then selling early would make complete sense. But the reality is almost nobody can do that on a consistent basis. Most investors in moments like this don't sell based on strategy. They sell based on fear. And that irrational behavior can lead to losses that are extremely difficult to recover from. This graph shows how a £100,000 investment with an 8% annual return over 20 years will be impacted if you miss some of the best days in the market. Missing just the 5 best days in the market, your portfolio would take a massive £300,000 hit. Now that's the difference between an average investor and a great one. Miss the 10 best days over 20 years and your returns will be cut in half. And those best days usually happen right after the worst ones, which is why timing the market can be such a risky game. You don't need to miss all of them for it to hurt your portfolio. Even missing a few can have a huge impact. So, while market drops are uncontrollable, they only turn into real losses the moment you sell. Now, this is the part that most people forget. Markets are volatile in the short term, but this is nothing new. Take a look here at this graph, which shows data that former Morningstar Director of Research Paul Kaplan put together, which includes monthly US stock market returns going back 150 years. What we can clearly see is that the market returns are far from steady. During this time, there have been 19 market crashes. Some of the most severe include the Great Depression. This led to a 79% stock market loss. There was the dot-com bubble burst and the Great Recession. But every single one of these have one thing in common: the market recovered. Now, of course, past performance isn't a guarantee, but it gives us a very strong indication of how markets perform over the long term. And it shows that being consistent and sticking to the fundamentals is one of our biggest advantages as an investor. So, while my portfolio might be down right now, but this is exactly why having a plan matters. Because when emotions are high, logic disappears. And if you don't already know how you're going to react in situations like this, the market will decide for you. So I'm sticking to my long-term investment plan, ignoring the noise, focusing on where my portfolio will be in 10 to 15 years, not where it is this month. If this video helps you stay level-headed during turbulent times like we're in right now, then be sure to hit that like and subscribe button so you don't miss out on real, no-nonsense finance content that we share every week. Thanks for watching, and I'll see you in the next one.